May we have our other expert panelist on the stage as well. May I invite Ms. Zara Ritchie, Head of Global Transfer Pricing Services from BDO. Welcome to you as well, ma'am. May we also invite Ms. S. Gayatri, S. Senior VP and Head, Tax and Regulatory, SR Energy. Join me in welcoming once again with your round of applause Mr. Naveen Jain, Head Taxation from Vedanta Limited. Welcome, sir. Well, on that note, it's time for us to push our thinking horsepower once again, and let's work on the strategies around the PE and attribution Chakravyuh, as we call it. On that note, Shefali, I'll hand it over to you.
Thank you. Good afternoon, ladies and gentlemen. We have this very exciting topic of attribution of profits to PE. And unlike many other panels that you've seen and you'd see through the course of the day, many of us can just afford to have questions and no answers. And that is because if you got the right advisors, then most likely you would never need to know these answers. In case you do get into the PE zone, that is where you will have to struggle with the principles on attribution and how do you really haggle on what needs to be allocated to the Indian PE and what deductions you will get from there. And for that, we've got a presentation today which is largely around what the global trends are, what the OECD says, what India says, the experience with the Indian revenue on that. A few cases that we've had, because unlike transfer pricing generally on the PE attribution, we still have very, very few cases. And then we are going to bring in some global perspective, since we have the benefit of Zara around with us. She's going to share with us what are the other countries doing, and then we've got two very prominent industry experts who are going to share their experience or their reactions on what India should be doing in order to give more certainty. Since we, I think Mr. Ranjan has already talked about it, and many other panelists today have discussed the need for the certainty in the transfer pricing world, and PE attribution is no different. We will have to look for more and more ways to get certainty, and unlike for transfer pricing where you already have an APA process which has now been flagged at a very successful event or successful program for India, I think on PE attribution we are yet far from there. So we need to find some common grounds where we can bring in this level of certainty on attribution of profits. So this is what we have on our panel today. I'm going to just broadly lay out the basic framework, and then we will move to questions. Hopefully we will have some interesting perspectives being shared by our panelists. And if any of you have any interesting perspective to add, please feel free to do so. But we've tried to at least think of all possible issues and bring them to you in terms of what you would see. And this is indeed, I think when Amaya sent this topic, it did have something saying back to the future. And you'd find by the end of it that it is really going to be something like going back to the future on this. So what is the authorized OECD approach on profit attribution to the PE? Taking one step back, if you have a PE under Article 5, then you go to Article 7 in the treaties and determine what is taxable in India. And the way Article 7 starts off is that if you have a PE, then the business profits of a foreign enterprise can be taxed in the source country only to the extent they can be attributed to the permanent establishment in India. And then for doing that, you need to go to paragraphs 2 and 3, which talk about that you need to then treat your permanent establishment as a distinct and separate enterprise, which is engaged in same or similar activities, operating under same or similar conditions, and dealing with the foreign enterprise wholly independently. So this is where your whole, arm's length principle comes about in paragraph 7.2. So the two primary approaches that OECD report, the original report, in 2010, which was published on attribution of profits to PE, laid out was the relevant business activity approach and then a functionally separate entity approach. The relevant business activity approach started off with saying that you have to look at the profits of the business activity in which the permanent establishment is involved. So as an enterprise, you may have multiple activities going on, but to the extent you have the Indian PE being involved in that business activity, you only limit the focus on that, and you start off only with the profits of the enterprise, which means that you have to limit the attribution. There is a cap in terms of only looking at the profits of the whole enterprise from that particular business activity. And then you had the alternate approach, which was that of the functionally separate entity approach. Now, this approach is more consistent with the arm's length price approach because it does not really limit the ability of the source country to tax the profits of the enterprise. In fact, it is flagged out as an administration-wise, it is a far more easier to implement option. It also allows you to tax the profits of the enterprise even before the profits are ultimately realized. So under the business activity approach, you will be able to tax the profits of the PE only as and when the enterprise itself has realized those profits. But in a functionally separate entity approach, you have the ability to tax the profits even before they are ultimately realized because it requires you to treat the Indian PE as a separate enterprise dealing with the main enterprise on an arm's length basis. So therefore, it is hailed out and to be a far more easy to administer the method. And OECD in its report has finally now endorsed this as the authorized OECD approach. It is interesting that while OECD has endorsed this as the official approach to profit attribution, many countries have expressed reservations and they have reserved the right to attribute the profits as per the domestic laws. So if you move to see how do you really apply this authorized OECD approach to attribution of profits, it is a two-step approach that normally goes. The first one is you have to undertake the functional and factual analysis of the activities of the PE. You have to hypothesize PE as a distinct and separate enterprise, and then go about identifying the economically significant activities or functions that the PE is involved in. So anything where the PE is itself involved, or there is any other part of the enterprise which is performing certain activities on behalf of the PE, you need to identify and aggregate all of them. And then you need to attribute the assets and the risks to the PE and the head office in line with these significant people functions. So this is your first step of factual analysis. It practically means that you have to draw up the tax balance sheet of the permanent establishment and then allocate the risks, the capital, and the profits according to that. If you then look at the second step, after having done this functional factual analysis, you then determine the profits based on the comparables. So this is where your transfer pricing principles kick in, and you have to do the FAR analysis of the PE, and based on that FAR, look at the comparables. Again, I think largely then you would look at the TP methods in order to do your analysis and find the comparables. And largely, we've seen the transactional methods such as CUP or the RPM or a cost plus being applied. Or in some cases, especially in some industries, you do look at the transactional profit methods, which are more like TNMM or profit split. So this is the broad framework on how you would go about attributing profits as per the authorized OECD approach. The latest report which was there from OECD was the discussion draft on the profit attribution in reaction and pursuance to the proposals under Action 7. The Action 7 Beps proposals on the amendments to the permanent establishment article largely corresponded to the changes in relation to the commissioner model or the changes in the dependent agent PE, where the threshold is dropped from a conclusion of contracts level to convincing the customers or doing everything leading up to conclusion of contracts. And in relation to this, what this discussion draft talks about is that when in response to these changes in the PE article, will there be any need to make any changes to the attribution principles? So that was the objective of it. And apart from the commissioner, we also have one or two other changes that have been proposed in Article 5, which relate to the specific piece, such as having a warehouse in another country, or segmentation, where you've actually split off certain activities into different entities, and through that, once all these activities and the presence for all those activities are aggregated, you then form a PE. And also to incorporate some of the concepts that have been introduced in the Beps guidelines around transfer pricing in actions 8 to 10. Now, again, here it's largely corresponding to the economic ownership of the intangibles. And what this discussion draft says is that while generally it was found that no substantive modifications are required to the principles laid down for profit attribution, there is a need for additional guidance. And therefore, what this discussion draft puts out is 4 examples through which they have tried to explore different ways of attributing profits. And these examples relate more to just, where you have a dependent agent PE, but certain risks are assumed or not assumed by that PE. Or in addition to the dependent agent PE, you have your own employee who is flying into the country and performing certain actions which lead to the dependent agency. And in such cases, how would you then allocate or attribute profits? So this is a discussion draft, and there is going to be an additional guidance. Zara, you mentioned earlier that this is going to be another draft and not the final report yet, which we will see later in later part of the year. So this is something to watch out for, but essentially this is the latest that we have from the OECD. Now turning to the domestic law, what does the Indian income tax law say on attribution? And the history is quite fascinating, because we have our original section 9, which again starts off with the profits of the enterprise, because it talks about under what situations profits of a foreign enterprise can be taxable in India. And where you have a business connection, it refers to taxability in India to the extent of operations carried out in India. And we are going to talk some more about it. What does it really mean to the extent of operations carried out in India? Now this then is followed by Rule 10, which talks about the attribution. And this is the only guidance which is there in the law as such, which says that if the AO is of the opinion that the actual income arising to a non-resident cannot be definitely ascertained, then it gives him the ability to arrive at a percentage of turnover, or arrive at a same proportion to the total profits of the business of such person as receipts accrue or arise in India bear to the total receipts of the business, or any other manner as the assessing officer may deem suitable. Now this, as we understand, is the global formulary approach, or the relevant business activity approach in some sense, which is being used in India, and the courts and tribunals have also been approving of the same. Globally, it is interesting that this is an approach where there is a lot of criticism. And maybe Zara, would you like to come in here and then share a global perspective on this?
I think it's fair to say that this was looked at quite extensively during the Beps process, because there was a lot of push by a lot of countries for consideration of an alternative to the ALP and going down a global formulary approach. But it was rejected, obviously, as we know. And I think that the problem with the global formulary approach is that it doesn't recognise the traditional concepts around, who actually is responsible for activities, who's bearing the risk, etc. So it's completely different to the arm's length principle in a sense. And so I think that it's fair to say that where countries adopt a global formulary approach, which is different to the arm's length principle, so the outcome is going to be different, then there's obviously a heightened expectation that we're going to have double tax risk. The only area that I think we'll see probably more of the global formulary approach is in the context of profit splits. And I think that you could talk all afternoon on profit splits, as we know, but I think that if you think about digital economy, if you think about globalization, if you think about the increased application of profit splits, and that's been indicated by your tax authority this morning, that you expect to see an increase in profit splits. I think any tax authority you speak to around the globe would say the same thing, that there will be an increase in profit splits, and I think this is the context in which we'll see more of the global formula approach.
Thank you. So we now move to the transfer pricing provisions, and this is just the last theoretical slide before we move on to some more interesting discussion. As we know, the provisions were introduced in 2001, and the definition of enterprise was expanded to include the permanent establishment of the foreign enterprise. As we say, several rulings that have happened already in the context of the PE and attribution of profits have confirmed that it is important to conduct the FAR analysis of the PE or the Indian subsidiary, if the subsidiary is alleged to be a PE, and so long as you have, had the arm's length price arrived at, nothing further should be attributed to the PE. Now, the treaty provisions also warrant the application of arm's length principle for attribution of profits, and what we're going to talk about through the further discussions is how does that interplay with the Indian law of Section 9 and Rule 10, which talk about a certain other way of apportionment of income, and comparing that with the arm's length principle under transfer pricing rules. So, quickly taking a look at the jurisprudence that we've had, the traditional case of Morgan Stanley, where the Supreme Court did endorse this single entity approach, where it said that once the Indian subsidiary was paid an arm's length fee, nothing further should be attributed, was further endorsed in the case of Seth Satellite, where also the tribunal said that once the Indian company was remunerated at a price which was more than arm's length, as was determined by the TPO, nothing further should be attributed. So in both these cases, we've seen that there was an endorsement of the single entity approach, which was also the traditional approach under Circular number 23, where it said that if you had a business connection, and if you had a business connection in the form of a dependent agent or an agent who was concluding contracts on your behalf, but if that agent was paid an arm's length price, that subsumes any profit that can be attributed to the business connection in India. And then we have another set of cases, which was one in the case of Rolls-Royce, where the Delhi High Court has held that the profit attribution requires robust TP analysis, of course, and in the absence of TP analysis, the court upheld the formulatory approach. Now, in this case, again, they had looked at the overall apportionment on the basis that, let's say at a broad level, 50% profit should be, allocated to the manufacturing activity, 15% towards R&D, and then that's how they came up with the balance 35% to be allocated to the marketing activities. But here, if you see, I think it was interesting to note that where the TP analysis has not been carried out by the taxpayer himself, that is where the formulary approach, has been brought into play. Now, in the normal course, where you're dealing with your group companies, it is okay and reasonable to expect that you would have your TP analysis done. But when you go into a PE situation, in most cases, you would not really go in believing that you have a PE, which means that if you don't know that whether you are going to have a PE or not, how do you do a TP analysis of the PE regardless? And how does that support you later on, where you get into a litigation where a PE is alleged, and then you have to justify that to that extent you already remunerated your PE? I think similar principle was also laid out in the case of GE, where again AO's calculation was upheld on the basis that 10% of the global profits or global sales were treated as the profits, and based on the formulary approach, a 26% profit allocation was approved for marketing activities. Then came the Convergence case, which was, again, a 2013 Delhi tribunal case, where it was a whole stepwise process was laid out on how you would go about apportioning the profits, where they said that you first compute your global operating income percentage, which is the operating income over total revenue, and then apply this percentage to your Indian revenues so that you come out with an operating profit from India. And then from that, you deduct what you have already offered to tax in India through your Indian subsidiary. And then the balance profit becomes the residual profit that has to be attributed between the global enterprise and the Indian PE. So then at the end, it goes towards a profit split of some sorts. Turning to the global developments now, Zara, would you like to now react from a global perspective in terms of what are the other countries doing in terms of giving clarity on the profit attribution, or getting their hands around, how to tax a foreign enterprise once they think that there is a PE?
So let me start by saying that the experience in terms of number one, is there a PE? And then number two, if there is a PE, how is profit attributed? I'd have to say that the most experience or the most case law and the most application of the rules, whatever those rules may be, is here in India. And when you look around the world for guidance, you really tend to come back to India. That's probably not very helpful to all of you, but that's the facts. So in terms of, let me start by making some comments on the AOA, if I start by that, and I'll talk about the MLI a little bit as well, and maybe make a couple of other comments in the context of PEs and profit attribution, and I might come back and make some comments about some references that were made to Australia earlier this morning as well, just to respond to some of those comments, because I thought it was interesting that some of the panel participants were looking to Australia for guidance, observations, experience, and I'll share some feedback on that. So the AOA, I think it's quite interesting. So the MLI, obviously we know the first party was yesterday, and 67 countries got together and signed up to the MLI, which is obviously a massive feat in itself. What's quite interesting though as well is that there were a lot of reservations, and I don't know if anybody else has had a chance to go through all of it in detail. I haven't. I have had a scan of it. And what's interesting is that you've got some very major trading partners that India deals with that have reserved on effectively Action 7, so the three components of Action 7. So countries like the UK and Germany, Korea, Singapore, Australia, if you want to say that Australia is a major trading partner. I think that Germany was a little bit of a surprise to some, given that Germany had moved early in terms of revising its own definition of what is a permanent establishment in its new bilateral treaties. And the main reason I think that many countries have reserved, and maybe you would say it's a provisional reservation, is because step 2 has not been addressed fully by the OECD, i.e. number 1, you've got a PE, but number 2, how do you then attribute profit to that PE? And as we know, the guidance is still under work and underway. So a lot of countries, fair enough, are not prepared to sign up to what that guidance might say until they know what that final guidance looks like. And that's been a very strong view expressed by the UK, and it's a view expressed by other countries like Germany and Australia as well. Australia's been a very, very strong supporter and leader on all initiatives with the 4 letters before it, Beps, but it has reserved in relation to Article 12, 13, 14 as well. So what's quite interesting, I think, is in terms of the OECD guidance on the attribution of profits, it's based on the authorised OECD approach, yet many countries around the world have not accepted or don't necessarily agree with the AOA, or if they do agree with it, they have only partially agreed with it, or they've partially adopted it, or they've adopted a variation to the AOA as prescribed by the OECD. And so I think it's quite interesting that in their July 16 guidance, All of the examples are based on the AOA, yet many countries don't actually adopt or agree with the AOA, and I think that's why we've got another revised draft which we're expecting from the OECD, because this is such a complex area, as I think we'd all agree. There are diverse views from as far as Germany to China, to Australia, to the UK, and all shades of grey in between. So the complexity of all of this is immense. And we all know that transfer pricing is an art, not a science. So it's unlikely that when that final guidance comes out, it is going to be scientific or prescriptive. There'll be a lot of art associated with it. So the other comment that I thought that I might make is in relation to Australia and the comments that were made. I just jotted down some thoughts earlier on just in response. So there were some comments that were made about perhaps advance rulings, and that Australia provides a lot of guidance and transparency in the ATO, the tax authority in Australia, in relation to its views on how it assesses risk. And I think that's true. So marketing hubs and financing arrangements post-Chevron are two, very obvious recent ones. And it is quite helpful in one sense, because what they do is they identify what constitutes risk factors and then grade those risk factors from no risk or low risk, being green, up to the very highest risk, being red or very high risk. And so if you're in the green zone, you can expect that you won't get any compliance activity, and that you're entitled to enter into an APA to negotiate an outcome in relation to whatever that matter is, to do with marketing hubs or financing. If you're in the red zone, you're guaranteed to get compliance activity, and by the way, you're not allowed to enter into an APA because they won't contemplate an APA in that situation. So it is for risk assessment purposes, but I think, as one of the panel members said earlier today, it does provide a level of guidance, and it does provide multinationals with the opportunity to acknowledge that guidance and therefore structure themselves around the guidance, knowing that if they fit into the green zone, no activity. If they fit into the red zone, they're likely to get a follow-up. What is really important to remember, though, and I would reiterate this, is that guidance is not intended to draw any conclusions about whether or not the arrangements that fall into green through to red mean that it's an arm's length outcome. Then they're not, the tax authority is not giving an opinion on whether that's correct transfer pricing outcome or not. They're just saying, these are our flags, and this is how we're going to rank you according to those flags, and this is the compliance activity that we'll adopt. The other comment that was made was, I understand, everybody understands there's a lot of litigation in India, and apart from the US, probably, the only other country in the world that has as much litigation. Many countries don't have a lot of litigation. Australia has been quite quiet. We've had a few cases, and of course, a most recent case, Chevron, is a very significant case, not just for Australia, but for the globe. And in fact, one of the guidances that the tax office issued post-Chevron, the risk assessment tool, I think predominantly is because the OECD still hasn't issued any guidance on financing after all these years, although I do believe there's something coming out either this month or next month as a first draft. So I think we're all waiting with bated breath to see that, which will be good. But Australia does have a culture of resolving disputes before they get to court, although that culture is changing, but that traditionally has been a culture. And it's been challenged quite a bit by the public, and the reason for that is because it's seen as doing deals, and that's exactly what happens. There is a deal that's done. Now, the deal is premised on the basis of the law, of course, but at the end of the day, it's a commercial outcome for both the tax authority and for the multinational to avoid the many years and cost of entering into litigation. But the tax authority is very progressive and proactive, and it probably, I think in Australia, we'll see more court cases rather than less. The only other comment I wanted to pick up on from an Australian perspective was the comment about the APA program and the delays and the maybe frustrations that you have with the Indian APA program. And what I would say is that that's no different to what the Australian APA program was experiencing many years ago when it was really first introduced. I would say, as hard as it is, be patient, it will improve. I think the experience improves both on the multinational side and on the tax authority side, so that the process does become more efficient. Of course, individuals, get more experience, and therefore the process does work more smoothly. And that's what we've seen in Australia. We also had the situation where you would take, you might be at the end of the APA term before you'd have even resolved it, particularly on bilateral APAs. And I think every country around the world experiences that in the early years of introducing a new program. So I would say that the only way is positive in terms of the expectation that the process will improve. The other thing that's happening around the globe, though, is where countries are opening up APA programs or expanding them, there's a lot more control around who will be allowed to enter into an APA program, so which multinationals will be accepted. So I don't think you can assume anymore that if you've got an issue that you can go to the tax authority and automatically apply for an APA. What we're seeing around the globe is a tightening up of APA. So whilst it's kind of counterintuitive, I think we'd all agree that whereas we're expecting more litigation, more reviews, more activity, post-Action 13, transparency, more inquiries, you'd like to hope and think that you have the ability to use more APAs to resolve disputes, but in actual fact, it's probably not going to be the case. Because tax
Zara, let me just
authorities-
interrupt you there. What kind of multinationals are being denied the APA programs?
Where there's no principle or broader importance on the topic, where it's more vanilla. So I heard the comment this morning that renewals will be efficient and straightforward. So in some countries now, you may not even get a renewal. Because the principle or the precedent's been set in year one. Most APAs now, I think, are where they're extremely complex, or there's an extremely high level of uncertainty, or there's a matter of principle that needs to be established in a particular industry or on a particular transaction.
So you'd say that if it is a simple one where there's already a precedent or an established markup, you would normally not see either the companies going for an APA or the authorities encouraging them to go for an APA.
Yep, that's right. And I think we're seeing more use of safe harbours or more desire for safe harbours for that reason as well, because that will take a lot of the problems of clogging up the system out of the system as well. Yep.
Okay, so that's how you keep your cases low. Okay.
So that's really all I was going to say on the only other comment I would make is the unilateral actions, and Australia and the UK, of course, have taken unilateral action in terms of diverted profits tax and deemed PEs. So perhaps we'll come back to that in the context of one of the questions later on.
So let me straight away go to the questions first. The first question, Naveen, I'd like to raise this to you. What should the taxpayers do? Is there really some arbitrage between, going to the tax treaties and, most of the treaties, if not all, if they do follow the OECD approach, then going under the treaties, trying to apply the arm's length principle there versus going under the domestic law and, going for a formulary approach? Is there a choice that the taxpayers have?
See, from the attribution of profits perspective and the corporate's perspective, the way the Amanis were constructing their business and seeking advice, the whole idea was they don't want to, have a permanent establishment in a particular country. So they want to structure their operations in a manner that you don't end up creating a P, because P comes up with its own complexities and attributions and uncertainties. Now, with the changed guidance and with the changed principles, as a corporate, first thing you would like to do here is you want to examine your operations, including the services that you provide, including the activities that you carry out in all the jurisdictions as a part of the business model, that which are the areas that are subject to the permanent establishment risk. Once you have done that, then you might like to take a call that, if I am subject to the PE risks, do I want to take a call that the PE itself is being remunerated at arm's length, price, which is, it's a related party, then it becomes relatively easier. You can take that call and not attribute any further profits to that jurisdiction. But if you're not there, and if the PE is being created because of there being not a related party, but an unrelated party, like a dependent agent, who you might be compensating, doesn't result into a arm's length attribution, and you still have to attribute the profits. You may like to examine the compliances and the transpricing study to be done to attribute profits there. Coming specifically to the question when you're examining whether there is a PE or not, if you end up with a better situation under Section 9, which is business connection, because you don't necessarily have to fall within the treaty language, because the way the things are getting, treaty language is getting more and more restrictive. So if under the domestic tax law under Section 9 gives you that advantage, or gives you that opportunity to not get into a business connection and get into the compliances, you may like to examine that, and it's a good situation to be in.
So related issue to that, and Gayatri, I'll turn to you for that. Many of the treaties, the Indian treaties, do have the force of attraction rule in Article 7. How would this rule interplay with domestic law Section 9 or Section 92 for that matter? Does the domestic law envisage force of attraction? Does it facilitate force of attraction?
See, very clearly, when we look at Section 9 and the adoption of the local laws, we look at business connection with all its narrow, wide, and interpretative, whatever is the situation. The point is, we've never looked at the force of attraction per se, because that's been largely very treaty-oriented. However, what I'd like to really bring out is the fact that there is so much of a kind of disparity or a disjointed situation between the domestic act and the treaty scenario. So on the one hand, you have here the business connection which you need to determine based on court decisions, etc. And to look at what could be attributed, you're looking at the formulary approach. On the other hand, you have the TP provisions, which have, as you mentioned, something for a permanent establishment. You have the possibility of the transfer pricing rules being adopted. The problem is, if you were to make a decision, how would you really, because these are two not really comparable situations, isn't it? And looking at the fact that Indian authorities, Indian tax law, is very gradually aligning itself to global regulations, I would imagine that sooner or later our Section 9 and Rule 10 and any other domestic provisions relating to permanent establishments would begin to resemble more the treaty provisions together with Action 7 and force of attraction and all the other aspects. But when this is happening, and my personal view is that when these regulations are being put in place, we should possibly look at how we can optimize or make most effective the aspects coming out of a deemed PE situations in Action 7. So for example, when you look at the dependent agent PE situation, in Action 7 and based on the additional guidance given, there are a whole lot of complex rules. There is, all of the parameters which talk about assets and risk, and how far the risk and the control of the risk, the assumption of the risk, and the financial ability to meet the risk, and how all of these really go towards ascertaining the attribution. It is, to be honest, very, very complex. I'm not at all sure that at a practical level, it's going to be easy to put down. Just to take an example, if you're talking about who controls the risk between a multinational enterprise and the dependent agent, here there could be so many nuances, there could be so many differences. It's not one or the other who controls the risk. Certainly there's, like one of the examples given, there could be no situation where the multinational enterprise simply hands over the entire control of the credit risk to the dependent agent. There's more likely to be a broad framework within which they are given this. And again, when you talk about who has, or whether anyone has a financial ability to bear the risk, there is always going to be a subjectivity of what is his financial ability and what is the special people's function which goes to determine whether or not there is a risk. So with all of these, what I would look for in the domestic act, as and when the more aligned to arm's length principles and more aligned to treaty provisions, is that there is a simplistic and more practical way of being able to attribute so that it doesn't involve endless litigation.
So then would you say that it is now time for India to bring in an arm's length approach?
Definitely, because I think that's the most easily understood approach rather than the formulae one, and mainly because it aligns with the way the world is going.
Right. Zara, any comment on that in terms of, how do you see the double taxation working in the context of formulary approach?
I think that there's a risk for a lot of double taxation if India sticks with a global formulary approach and other tax authorities adopt the arm's length principles. So, we all know that it's hard enough to agree where you agree in principle as to what the outcome should be, but where you're starting from a different base, you're going to end up with a different outcome. So I think that most countries adopt the arm's length principle, and I would certainly agree that it would make a whole lot of sense if India went down that path as well.
Shefali, can I add a point there? Being in oil and gas and the 44B section and presumptive taxation for the oil and gas service providers, because it becomes so complex. You get a rig from somewhere, the equipment from somewhere, material from somewhere. How to allocate the profits to the the services provided in India. The formulatory approach becomes an easy approach because, if your global profits are 10% and you need to allocate on the basis of turnover, the 10% is the most simplistic approach, no disputes, nothing. But, to recognize the practicalities around, because different industries, different players, there could be situations when you're ending up into loss in a country because of because of going into a formulatory approach and not an arm's length kind of approach. As a corporate, can you have the best of the both worlds, like a Rule 10 kind of situation, that you attribute a particular profits based on the global profits? Or if that's not the case, if you can put a transpricing report and justify that, you follow that. But what I'm saying here is that it's not that formulatory approaches is something which corporates will not look forward to. A lot of times, as a head of tax, if I have the option to go for a formulatory approach, it's simple because I know it's certain. I pay this tax, it's my cost, it's over. A lot of times as a contractor, I have to pass this cost.
The only difficulty there, Naveen, if I may just add, is that, you would know, but you'd know only afterwards. You would not know that upfront, right? Because in most cases, you would not be in that situation to be able to predict at the time of going into the transaction how much of profits is really going to be attributed.
Which is a fair point. If I try to get a band around that or something around that, like 44BB, it really makes me more motivated to go for a formulatory approach.
So are you proposing that we expand the scope of presumptive taxation to many other industries?
No, we are thinking aloud, because at the end of the day, the whole idea is not to get into uncertainty and a lot of pressure, So if there is something possible, if say 10% is a very decent kind of attribution principle, which was enshrined in the Rule 10 also, why not?
Maybe for oil and gas, not for certain other industries. So coming to the next one on the digital economy, I think the challenges around attribution get further highlighted when you're talking about a digital economy industry, where the business models are such where the profit margins, of course, are very low. Secondly, it is very difficult to identify the significant people functions, because a lot of it just operates without any people. So then, the how do you go about attributing profits? It's a challenge globally today, because, first and foremost, they are still trying to get the hands around how will they determine a PE in the context of digital economy. Should there be different principles as compared to Action 7, which till now they have resisted from doing, but still the final action recommendation on digital economy is yet to come. And especially where you have physical equipment, such as a server or a data center, how do you really go about attributing profits? Would you really say that, it's only limited to the extent of the physical investment in that infrastructure? Or would you say that the activity that that equipment performs, with or without any people, should still be attributed to that equipment, and that's how you'd go about attributing the significant people functions or profits relatable to that? Or in the context of online contracts, really how relevant is the marketing activity that happens on ground, where you are talking to the customers, but the rest of it all happens electronically. So I would say that the challenges around attribution of profits get enhanced manyfold when you're dealing with digital businesses. What I'd like to do now is take you back to the Formula One case, which is one of the very famous landmark cases that we've seen in India in recent past. And the reason we picked this case is that while we have a ruling from the Supreme Court on the permanent establishment, we are yet to see the ruling on the attribution. So the facts briefly are where the Formula One World Championship Limited, FOWC, which is a UK resident, had a PE in respect of a Grand Prix motor racing event, which was conducted in India. The circuit was owned by another unrelated party in India called JP. And it was held that the circuit was a fixed place at the disposal of FOWC in India, through which it carried on its business. And the focus of the court and the factors that were highlighted as significant factors influencing this outcome were that the commercial rights in relation to this racing event were with FOWC, and these rights, while of course FOWC had the commercial rights to carry on these races worldwide, and in this particular year, it had licensed or given these rights to the Indian company JP for hosting the Indian racing event. And because the commercial rights were exploited by the actual conduct of the race in India, there was that nexus or a significant economic activity which was carried on in India, which led to the permanent establishment inference. The fact that this was a short duration contract, the race was only for 3 days, and that would not make any difference in this case because the contract itself was for 5 years at least. And the fact that it was a short duration presence or a place at disposal for a short duration, but over a period of time of the contract, I think that had some influence on the court's decision. It also said that FOWC had complete access to the circuit during the event when no other event was possible. The exclusive nature of access and the period for which it is accessed makes the presence of a kind which is envisaged under Section 5.1, Article 5.1, and therefore it held that the FOWC had a fixed place PE in India. And of course, the case is remanded back to the assessing officer for attribution of profits. So in this context, I would then like to turn to my panel to do some crystal ball gazing as to what would be the relevant factors that would be considered while attributing to the profits to FOWC. So just to again remind, I think the ruling says that FOWC has a P in India. So the fact that there are other entities belonging to the group who also have contracts which are also being exploited in India should not have any direct reference. It is, we are talking about FOWC's income in India and what should be attributed to that in India. How would you go about allocating the intangible assets, and how would you identify the significant people functions? The floor is open. Who would like to go?
Shefali, I think that's very interesting because as clients, a lot of time you face the dilemma whether you admit there is a P in India or not. And if you admit P in India, whether you go to the attribution route or not. See, typically what happened in the Convergys case also, a lot of people disagreed there was not a P. But the liability which was coming on after attribution of profits was not at all significant. So from a corporate perspective, you still want to take a decision to pay the liability because even attribution is not resulting in a significant attribution. Why get into endless litigation? So having said that, the way I look at it here is if the entire activity of doing the racing, which was being organized by JP, and because the racing track becomes a fixed place of business, and if that becomes a permanent establishment, if that permanent establishment has been trying to get somebody to organize a race, and Formula One being a brand in itself, the substantial consideration could be attributed towards the brand, which is the Formula One brand. Because the fact that it was a Formula One race, the world will come and watch it. The fact that it is not a Formula One race, any other races which JP would have organized will not have got that kind of publicity. So the major consideration is actually towards that Formula One brand. And if the dampe functions around all that a brand is being performed outside India and not in India, majority, even if the attribution has to be looked at, I believe majority of the consideration will be out of the tax net. And I'm not sure how much, if you do an analysis around that, how much of attribution could still lead to, on account of the racing track being a P. But
What about the people functions, Gayatri?
Yeah,
I think you did say that, the fact that there was a commercial exploitation in India seemed to give an impression that, there should be a fair bit of attribution to India.
Certainly, that's what I believe. And I also believe that it's not necessarily, it does not necessarily have to be a fixed place P. Because if we are going to look at the two-entity approach, as Action 7 suggests, then there are these, how it's going to be attributed is going to be based on the asset to the extent used and the control over the asset. And then the case law does tell us that they retained most of the control or much of the control themselves over the asset, how far it used to be used, it was to be used, and there were a lot of restrictions around it. Also, the risks in terms of, I mean, there could be a whole lot of risks around the entire staging of the show, and while the implementation related risks would be that of JP, there were others held by them as well. So I think what's going to happen is it will be an arm's length and a profit split method kind of approach that would determine.
Zara, any guesses from Australia? For the races that get conducted in Melbourne, if the ATO were to take a similar approach, how do you think they would go about attribution?
I think Australia would look at the activities, on the ground, the people functions, and in terms of the, I think it'll be really interesting to see the additional guidance and how control of risk, management and control of risk and intangibles is brought out in that. I think the ATO has not had a lot of experience with permanent establishments, to be honest. Most companies, if you suggest that there's potentially a PE risk, would say, thank you very much, and that's the end of the conversation. And so there hasn't been a lot of experience, there hasn't been any case law. So I don't think that the tax office would have any views on it other than traditional transfer pricing principles and looking at that connectivity.
That's one thing. You asked about people function. Interestingly, in much of the work that was done, there's possibly not going to be much of actual people function carried out, since it related to the exploitation of the asset by and large and the controls that they exercised. So it's going to be very interesting to see, as to how far this whole parameter is even useful to determine an extent of control. So.
Agreed. I think based on the different industries and the different models and how they operate, the weightage that gets assigned to each of these factors could vary.
In fact, Shefali, just one more thing on this whole people function, and then keeping in mind our back to the future kind of thing. I want to say that people are going to play less and less, importance in the whole determination, because if you look at, and yesterday's news said that our own tax authorities are likely to have a jurisdiction-free assessment, reducing the necessity of interface. And then we are looking at a very creeping but sure case of artificial intelligence taking over in the next 5 years, and if not 10. When it's not going to be the amount or the extent of the hours or intellectual exercise or discussions or debates that people are going to engage in to determine. So it's interesting to see how things pan out.
Right. So just last one or two questions before we open up the floor. Zara, do you think the extent of attribution may be different where you're looking at a single P situation versus a situation where there could be multiple Ps?
I think it depends how you interpret that question, but if you take your Formula One case and take the facts of that, where there's one entity with potentially a PE, but then there's other multiple entities that are associated with the Formula One event, if you like, then each of those other entities could also have a PE. And so, yes, you potentially have got a different approach. You've also got potentially a lot more profit that could be attributed, let's say in India in the Formula One case. So, I think the extent of attribution could be different, absolutely.
And then how would the attribution differ based on what type of a PE you have? So for example, in Formula One case, they said that there was a fixed place PE. Let's assume they said that, there is an agency PE, and the manner in which JP was operating seemed more like a dependent agent. Would the attribution outcome be different in that case?
I think this is a fundamental question. I mean, if you go to the OECD guidance on profit attribution and look at their examples, there is an acknowledgement that if your dependent agent PE is being rewarded on an arm's length basis for the activities that it's performing in country, then there is nothing further to attribute to the non-resident. And I think that most people would agree that that makes a whole lot of sense. It's really a question of where there are other activities that are performed that are not appropriately being rewarded to that local entity, that creates this question of what that attribution result would be. So, and then you come back to things like intangibles and risks and some of the more esoteric types of aspects that perhaps are not being rewarded, or perhaps the local entity is not being appropriately rewarded in the first place. But to me, with a dependent agent PE with an arm's length return for the actual functions, assets, risks that it's carrying out, that should be the end of the story. It's a different type of PE question.
So coming to the...
Just to add, Naveen, for instance, said it could be a fixed place PE. I think the concept of PE will really determine the approach. So if it's just the track you're looking at, as he mentioned, you possibly look at a narrower scope. If you said dependent agent, you'd make it far more wide.
Or
could make a
or
difference.
looking at it the other way, then you would pretty much get down to the situation where once that in this case it was an independent party, right? So assuming that you've already met the arm's length price, there would be nothing left to attribute. True. And I wonder sometimes, if going forward would the tax authorities look more at the outcome and then go about whether do they really want to figure out if there is a P? Or would they first go about, just asserting a P and then work out the outcome? Because sometimes, depending on how the facts are placed, and the facts are fungible, right? Because, we heard earlier in the day that looking at the same set of facts, the tribunals are also giving different rulings. So it is, how you read it and how do you apply the facts, and it could be very different in different situations. So the only last point that I'd like to make before I close our discussion here is that unlike many other situations, and now with transfer pricing disputes, we do have this very robust APA program where you have an upfront clarity. Unlike that, for PE attribution, we don't have anything. You have to go in thinking that you don't have a PE. You'd come out with the tax authorities alleging that you have a PE. They would look for facts, and if your facts are not supportive, you will have a PE. And in that case, you are looking at the situation post facto. So in that case, what options do you really have other than going through the competent authority procedure under a MAP, or coming forward and offering up to settle? Now, we don't have a mechanism for settlement, and for all due reasons, I think till the time we are ready for it, that may not be the right approach. But is there a way where, even where you don't have your related party in the source country, if you think that you might have a PE for some reason, is there a way we could offer that same, certainty by saying that assuming that you had a PE in this form, this is how your attribution would work out. So long as you, agree to pay this amount in India, nothing further should be attributed. And maybe, you know, we should look at some possibilities and some other precedents where the other countries are also including the PE, profit attribution to the PE, in their APA programs. We are already behind the schedule, so I don't know. I mean, Arun, do you still want to? Okay. But I think Mr. Ranjan is sitting in the audience, so we'll have to turn to the audience only for answer. All right, thank you very much. I'd like to thank all my panelists. I think they've done a great job. I think all of them, you know, got out of their comfort zone and thought about it. So thank you very much. And thank you all for a very patient hearing and waiting for this. Thank you.
Thank you very much, panel, for sharing your perspectives indeed on an intrinsic topic, as ma'am said. And Shefali, thank you for leading the session with that presentation out there and leading it out perfectly well. So may we request all of you to please come forward for a group photograph. And yes, ladies and gentlemen, I know after a lot of food for thought, yes, it's time for food to beat our hunger pangs. So of course, I'll leave you all for lunch. We do disperse for lunch, but we meet sharp at 2:30 p.m. So please enjoy your meal out there, but we reconvene at 2:30 p.m. Thank you very, very much. And thank you to the panel speakers once again. There's a lot more coming way, ladies and gentlemen, so please be on time, stick to time, and stay tuned with us.